Thanks to the hard work of the folks working over at Wall Street on Parade, which is a popular finance blog, we now know more about the truth about the 2019 repo madness crisis, and it's not pretty. So over the last few weeks, the people over at Wall Street on Parade, and it seems that there's been, according to articles and other sources cited in the articles from Wall Street on Parade, there's been a mainstream financial media blackout on this information, even though the Federal Reserve Bank has released some of this information publicly in the last few weeks. The mainstream financial media is not reporting on it, and I would say that's intentional because they were told not to or threatened not to, that the repo madness crisis in 2019, and I did many videos in the archives. You can go look up repo madness. I did a ton of repo madness videos in 2019 on this. There was a ton of covert bailouts. If you're not familiar with what happened, I'll just summarize it very quickly. The Fed's official balance sheet, in the span of about 2.5–3 months, it went up $1 trillion officially. But from speaking to sources, and these are sources, whether those are former investment bankers, hedge fund contacts, or former portfolio managers at investment banks, there was a lot of failures of these leveraged bond trades, these trades like the leveraged short volatility trade, the risk parity trade that Ray Dalio's hedge fund, Bridgewater, him and his hedge fund invented. Bridgewater also blew up. From the information that I've gathered back in 2019, Bridgewater also got a massive bailout. So these leveraged trades on currencies, bonds, stocks, derivatives, leveraged short volatility trade, risk parity trade, the basis trade on US Treasuries, and other types of leverage trades. These trades blew up because of leverage and because the Federal Reserve Bank back then was still raising interest rates and was tapering quantitative easing. Does that sound familiar? We might have a repeat of the 2019 repo crisis now. And this is why I believe, in my opinion, this reverse repo that people are saying is removing quantitative easing that canceled out QE, it's bullshit. It's a head fake with reverse repo. Because the Fed's official balance sheet, and the Fed's official balance sheet, in my opinion, which is not accurate, is still around $9 trillion. It's up enormously in the last 2.5–3 years. The Fed's official balance sheet was only, I think in mid-2019, it was around $3 trillion, and then it jumped by $1 trillion in only a couple months during the 2019 repo crisis. And then now the Fed's balance sheet is still rising rapidly, despite supposedly the Fed claiming that they're tapering. But look at the U.S. debt clock. The U.S. debt clock, in just the last month, the U.S. debt clock is up another $700 billion. We're almost up to $30 trillion in official national debt, whereas those numbers do not match with the Fed's official balance sheet and the size of the budget deficits. So who's going to buy those U.S. Treasuries? It's not going to be the large banks, which said over the summer in 2021 that the U.S. federal government was selling too many U.S. Treasuries. The banks could not buy them all. They said they would buy more. They said they would not be able to buy them all. And foreigners are not buying anywhere near the amount of U.S. Treasuries. So the Federal Reserve is the buyer of last resort of U.S. Treasuries. As long as these budget deficits are big and bloated and keep increasing, the Federal Reserve and the official balance sheet will have to keep increasing. Also, and this is another reason why I don't believe the reverse repo numbers, now it is legal after March of 2020 for the Fed to have off-balance sheet special purpose vehicles. So we don't know what the Fed's real balance sheet is. We don't know what the Fed is hiding off balance sheet. I suspect it is way larger. And this brings me back to the research that Wall Street on Parade had about the 2019 repo crisis. They have said that the numbers were actually over $11 trillion in emergency loans. I think that number is pretty accurate from what I've gathered with different sources, speaking to different sources about the repo crisis, reading articles, and speaking to a number of different sources off the record. There were a lot of large banks and a lot of hedge funds bailed out in 2019, and this was 8 months before the pandemic. So the global financial system and capital markets and asset markets actually blew up during the 2019 repo crisis. The Fed lied, of course, and said the repo crisis wasn't that big a deal. But the repo market is basically a pawn shop. If you're not familiar with Lehman Brothers blowing up, they blew up because they couldn't get an emergency loan from repo, even though now $20 or $30 billion doesn't seem like very much anymore. But at the time in 2008, when Lehman Brothers did blow up, they could not get that amount in an emergency loan with the collateral that they posted for repo. And now the Fed has 2 permanent repo facilities set up. I've talked about that in prior videos. But the bottom line here is that through Federal Reserve Bank disclosures the last couple weeks and through articles that Wall Street on Parade is releasing, and I don't see anyone else releasing them, it appears that JP Morgan, Deutsche Bank, there's some anecdotal evidence there, and other banks, and we know that hedge funds blew up because they were all copycatting each other on these leveraged trades with risk parity, with the leverage short volatility trade, with the basis trade, with other leveraged trades on currencies, bonds, derivatives. And then they got caught on the wrong side of the trade. They got caught with their pants down when the Federal Reserve continued to hike interest rates and also continued to taper quantitative easing. And this is setting up for the Fed will not be able to fight inflation with rate hikes or tapering quantitative easing. The Fed will simply just blow up other leveraged trades and create even more margin calls if they are actually serious about hiking rates a couple times. The system with these over-leveraged trades is so levered up, and we know this with Archegos and the mainstream financial media and the large banks like Credit Suisse and others covered up that there were more hedge funds and family offices with similar leverage problems than just Archegos. It was way larger than just Archegos. It was all swept under the rug. Notice how no one's talking about it anymore with Archegos. So we now know that there's pretty good evidence that the size of the emergency repo that the Fed pawn shop took in was over $11 trillion. In emergency loans, there was almost definitely, if the number is that size, derivatives failures. When you're talking that size, you're looking at big margin calls on over-the-counter derivative bets, probably on interest rates and interest rate swaps because the Fed was hiking rates. And a lot of these large banks, JP Morgan and others, their derivatives positions, Rob Kirby has talked about this for years, were betting that interest rates would not rise. So a lot of their derivative bets, they're net short interest rates. They're betting on financial repression. They're betting on Japanification. And when the Fed does hike rates, they don't fight inflation. They just blow up leveraged trades. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want far more in-depth content research, financial education, and analysis than I provide in these short little free videos, there are now over 190 articles and audio podcasts behind my paywall, exclusive for patrons, all for the cost of a Starbucks cup of coffee per month, only $5 a month. I think it is one of the best deals out there. And just in the last 25 or so weeks, there are now 38 new articles and audio podcasts, including 7 new audio podcasts out in the last month or so, all for the cost of a Starbucks cup of coffee per month. The last 2 audio podcasts are updates on the uranium market. Hopefully in the next couple weeks, there will be audio podcasts or articles out on gold and silver mining, a geopolitical update maybe on Canada and Argentina. Argentina is surprisingly attractive now for a lot of large and medium-sized mining companies, and then one on oil and gas. And again, that is all for the cost of a Starbucks cup of coffee per month. So if I could wrap up this short little video very quickly, there are a lot of articles out over on the Wall Street on Parade website. I'll attach links to some of the articles below the video in the information and description section, showing that in the 2019 repo madness crisis, and I was doing a lot of these videos at the time telling people that there was trillions in covert bailouts to large banks and hedge funds from trades that blew up. I was hearing from contacts that Ray Dalio's risk parity trades had all blown up. So everyone that was copycatting the risk parity trade blew up and needed bailouts. The Fed claimed that these were only short-term emergency loans with good collateral. The truth is the exact opposite. The truth is that before the Fed was legally allowed to set up special purpose vehicles off balance sheet, the Fed created currency units out of thin air, trillions, and bought bad toxic sausage assets, bad trades, to protect large hedge funds from failing, their counterparties from failing, to protect large banks from having enormous losses and failing, and paid 100 cents on the dollar for these toxic sausage assets, all while not being transparent about it. We may never know the entire truth because the mainstream financial media either is being forced to or just simply won't, voluntarily won't, report on this accurately. But the bottom line here is with a dollar standard system, with the world reserve currency, with the Federal Reserve Bank, the most powerful central bank in the world, they can pick out winners and losers. They can bail out whoever they want. Normally it is the government. Normally it is large Wall Street banks. Normally it is hedge funds or family offices or private equity. And normally it is large corporations. And that is screwing over Main Street more and more. And this is why you don't have real deflation, because the entire system is built on currency creation on a minimum amount of inflation and bailouts, or stagflate, tax lie, asset price inflation, and the Cantillon effect. And the Fed raising interest rates or tapering QE, if the Fed is serious about it, they will probably create as bad or worse conditions similar to the 2019 repo madness crisis in the next 6 to 8 months, perhaps sooner.